Rivian Automotive Inc. is currently trading at $17.32 as of April 21, 2026, marking an intraday increase of 2.01%. This upward move comes during a session where the stock has shown notable resilience, bouncing off a daily low of $16.76 and testing a high of $17.15 before consolidating near its current levels. While a 2% gain might seem like standard volatility for a high-growth electric vehicle player, there is a deeper reality shifting under the surface that most casual observers are missing. The narrative around this company has long been centered on its cash burn and the daunting challenge of scaling production, but the actual data from the first quarter suggests a significant decoupling from the broader EV slump. The expectation from the general public is that Rivian is essentially another speculative play, trapped in the shadow of a dominant Tesla stock or the deep pockets of legacy players. However, the reality is that the company just confirmed it produced 10,236 vehicles and delivered 10,365 in the most recent quarter. When you see deliveries outpacing production, you are looking at a company that is efficiently clearing its inventory and managing demand in a way that many of its peers simply cannot. While many people are busy looking at the flashy headlines of the upcoming R2 launch, the smart money is focused on the fact that Rivian has reaffirmed its 2026 delivery guidance of 62,000 to 67,000 vehicles. This is a massive jump from 2025 levels and suggests a level of operational maturity that the market has yet to fully price in. If you look at the institutional activity over the last several weeks, there is a clear trend of accumulation. Large funds are no longer treating this as a lottery ticket. They are viewing it as a legitimate alternative to the volatility of an individual brokerage account filled with unproven tech. This shift is partly driven by the massive $5 billion joint venture with Volkswagen, which has essentially acted as a financial backstop. This partnership did more than just provide liquidity. It validated the company's internal software and electrical architecture. While people often compare it to Nvidia stock in terms of its technological lead in its specific niche, the reality is much more grounded in manufacturing logistics. The company is currently sitting on roughly $6 billion in cash, and with the additional capital from Volkswagen, the fear of a near-term bankruptcy has largely evaporated, even if the path to total profitability remains a steep climb. The stock is currently positioned in a very interesting technical spot. It is trading well above its 52-week low of $10.85, yet it remains significantly below the high of $22.69. For those using a SoFi trading platform or checking their positions on the Robinhood app, the daily swings can feel erratic, but the volume tells a story of steady interest. We are seeing average volumes of over 25 million shares, and today's activity is tracking right along that line. This isn't just retail hype. This is the market digesting the implications of the R2 platform. The R2 is expected to be the true driver of volume, aimed at a $45,000 price point that opens up a much larger pool of buyers than the premium R1 series. Most investors are conditioned to expect a disaster every time an EV company mentions a new launch, but the reality is that Rivian has been systematically reducing its cost of goods sold per unit. They improved their automotive cost per unit by nearly $9,500 over the past year. That is a staggering figure that directly challenges the incapable of profit narrative. While the company still expects an adjusted EBITDA loss between $1.8 billion and $2.1 billion for the full year 2026, the trajectory is clearly pointing toward a break-even point. This tension between the current losses and the narrowing margins is where the opportunity lies for those who understand the long game. When you look at the broader landscape of online investing, it is easy to get distracted by the performance of Apple stock or the latest trends in crypto. But the fundamental shift in transportation is still happening, and Rivian is positioned as the primary beneficiary of the premium electric truck and SUV market. The commercial van side of the business, backed by the ongoing relationship with Amazon, provides a steady floor that many other startups lack. This isn't just about consumer luxury, it's about a vertically integrated tech company that happens to make cars. They own the software, the charging network, and the direct-to-consumer service model. Comment below how many shares of Rivian you currently hold and what your average cost basis is. Are you buying the dip, or are you waiting for the R2 to officially hit the roads before you commit more capital? It is important to see where the community stands on these mid-cap growth plays, especially as we head into the next earnings report. Speaking of earnings, the company is set to release its first quarter 2026 financial results on April 30th. This will be the next major catalyst. The expectation is a loss of around 73 cents per share, but the real focus will be on the gross profit margins. If they can show another sequential improvement in how much it costs to build each truck, the stock could easily test that $20 resistance level. We've seen this play out before, where the market overreacts to the headline loss and ignores the underlying efficiency gains. For those who use Interactive Brokers or Fidelity brokerage accounts for their long-term holdings, Rivian represents a classic show-me story.
The company has moved past the can they build it phase and is now firmly in the can they scale it profitably phase. This is much less risky than the early days, but still offers a significant upside compared to the established giants. If you are looking at Fidelity ETFs or other mutual funds, you'll notice that Rivian is starting to pop up more frequently in growth-oriented portfolios as the risk profile stabilizes. Let's look at the business model for a second because it is often misunderstood. Rivian isn't just selling a vehicle, they are selling a proprietary ecosystem. Their software and services segment alone generated nearly $450 million in revenue recently. By controlling the entire stack, from the battery management system to the infotainment, they are creating a high-margin recurring revenue stream that will eventually offset the hardware costs. This is the same blueprint that made the leading tech stocks so successful over the last decade. They are also expanding into energy storage partnerships, which adds another layer to the valuation that isn't yet fully reflected in the $17.32 share price. The recent tornado damage at their Illinois plant over the weekend caused a brief moment of panic, but management was quick to clarify that it primarily affected parts storage and logistics rather than the main production line. This is the kind of reality versus expectation moment we see often. The expectation was a major production delay. The reality was a manageable logistical hurdle. The stock's ability to stay green today despite that news is a testament to the current strength of the buyer base. In terms of the future outlook, 2026 is being framed by the CEO as an inflection point. While 2025 was about fixing the balance sheet and securing the Volkswagen deal, 2026 is about the physical expansion of the brand. The R2 launch variant is starting with a single shift, but they plan to add a second shift by the end of the year. This suggests that the internal data they are seeing is strong enough to warrant a rapid ramp-up. For anyone doing their own online investment research, these production shifts are often the most reliable lead indicators of future revenue growth. We also have to consider the macroeconomic pressures. High interest rates have been a massive headwind for expensive vehicle purchases, but as the Federal Reserve begins to signal a shift, the affordability of a Rivian becomes much more attractive to the average consumer. This is why you see such a divide in analyst price targets, ranging from $9 to $30. The bears are focused on the current interest rate environment and the cash burn, while the bulls are looking at the 50